right? DeFi markets performed flawlessly, transparent, on-chain. It all worked. We did the same liquidations that the CeFi lenders did, except DeFi didn't screw anyone over. It actually performed exactly as it was supposed to. It's because our regulations are based in smart contracts. So the SEC and other regulators could view DeFi as part of the solution here. Hey, Bankless Nation, happy Friday morning and happy 4th week of June. This is the last week of June. We got a lot to cover here, David. I'm fresh back from last week. I did get COVID last week. I went to the beach, had some fun, but also got COVID. So I'm a little bit under the weather, so I'll try to meet the coughs, David. But how you doing, man? Your new place looks great.
Yeah, thanks, my man. Doesn't the brick look pretty good? I got some big plans for what's going on behind me in the future.
Yeah, what are you thinking? Some like little NFTs?
I got a little bit of NFTs, but more than that, Bankless Studio. The plans for Bankless Studio is underway. More on that later in the show.
All right, we'll save that to the tease at the end. But we got some hot things to cover, some big things to cover. I came back and I feel like I left kind of shaking my head a little bit, and I came back and I'm just like still shaking my head. Like, what a mess. Last week was a complete mess again. I think the theme of the episode today, the roll-up today, is crypto contagion. Once again, it's continuing to propagate. But we've got a few stories we're going to chase down. What's the first one, David?
Yeah, we're gonna recap the dust that is settling around the 3AC Capital meltdown. We've done this a few times before already, and the dust continues to settle. We are finally starting to get some clarity, although there's still much more clarity needed. So we're gonna go through all of where we is beginning to shake out as the final part of the story of 3AC Capital. And then that bleeds right into the story of BlockFi. Again, the same stories that we've been covering, but because 3AC Capital was related to BlockFi, we gotta cover the settling of the BlockFi issue as well. BlockFi, where it was previously raising at basically a $5 billion valuation about a year ago, is now being valued between $25 and $50 million. There's differences between those numbers. That's down bad. But then that bleeds right into the third big story of the week, which is that Grayscale is suing the SEC. And all of these stories are related to each other. One just like flows right into the other, which brings us back to like the theme of this whole entire market, which is contagion. And it really, Ryan, it all kind of comes down to the GBTC discount. And so we're going to walk the viewers, the listeners through like how all of these things are tied together, how one rogue venture fund that everyone thought was Chad's was connected to this GBTC Grayscale Trust, which is an inferior product as a result of the SEC regulation. Whose fault is the bear market? Well, it's a lot of people's fault, but we can definitely name some names. And so we're going to cover all those stories.
All right, we're going to be naming names for you. Is that what you want in the bear market, guys? For us to talk about things that people did that were just straight up dumb? Because that's what we're going to do in today's episode. I think we have to camp on that to learn from our mistakes, hopefully. Also, wanted to tell you about our friends at JUNO. JUNO is a crypto bank. Okay, but it's not like all the other banks in that it has remained solvent. And actually, this is kind of a bank account that I think of as DeFi's best friend, because they are so crypto native and so DeFi native. David, what kind of things does JUNO provide in a bank account?
JUNO, I think, pretty much has the world record for the fastest connection between your checking account and an Ethereum layer 2. So JUNO, it's like your new financial services, crypto-enabled financial services. You can get a checking account with on JUNO, and you can go from your checking account to Polygon, Arbitrum, Optimism, and then they've also are working on their Starknet and ZK syncing integrations as well. So like that's already mind-blowing. Like checking account to layer 2 in seconds. You can also swap your money for crypto assets with zero fees. We love that. And you can also, in your on JUNO checking account, get 6% on your USDC, or it's 3% on Ether or 3% on BTC. And so like it's the crypto-enabled checking account for the future of the world. I mean, the ad just writes itself.
Yeah, absolutely. And you may think, hey, why are the Bankless guys telling me to go open a bank account? Well, we're literally telling you to go do that because this bank account is so crypto native and crypto enabled. And look, you know, you're never going to get rid of your bank account. There's always going to be a place for the banks. But this is what a neo bank really looks like. It's completely connected to the crypto world, and there's no borders. You have seamless transition between both. So know you guys probably want to get started. You can head on over to the link in the show notes. And when you do, there is a $10 back reward on your first crypto deposit. and also $100 when you set up a direct deposit, because once again, you can actually get paid in crypto through JUNO as a service too. So go check that out at juno.finance/bankless. All right, David, let's get on the markets report. So what are we looking at with Bitcoin price this week? We're down, it looks like.
Yeah, it's one of those weeks like, it's down every single week, isn't it? Started the week at $20,500. We are currently at $19,000. Just a few dollars above 19,000, down 7% on the week. Oof.
That does not feel good to be below 20K. That's definitely bear market territory. It's getting chilly down here in the cold. How about ETH? What are we looking at on the 7-day here?
Yeah, Ether started the week at $1,100. We are currently at $1,026, down 6.7% on the week. Oof.
Flirting with that triple digit ETH.
I saw triple digits this morning. Yeah, we got
this morning. You saw
I saw 999.99. I was like, wow, that's a number.
That sucks. That's a bad number, huh? You think?
Not for buying.
How deep is the cut here? How deep we going?
Oh God.
You want to make some calls?
I mean, I think we're gonna have plenty of 3-digit buying opportunities. Maybe not plenty, but like there will be numerous buying opportunities. There were 3 times I remember being able to buy $80 Ether in 2018 to 2020. This is the second time that I've seen triple-digit ETH. So count them, like 2 times.
There you go, guys. Look, if you're bullish on this space as we are, and if you're as bullish as on ETH and some of these other assets as we are, this is an incredible opportunity. Now, I'm not saying that we're going to go up overnight, but I am saying that probably over the next weeks to months, maybe years, I don't know, will probably be one of the few triple buying ETH opportunities, if not the last one we ever see. But who knows? I mean, quote me on that later after I'm right. Don't quote me on that right now.
Not yet.
Forget I said that during the bear market. ETH to Bitcoin, the ratio, what are we looking at this week, David?
It's basically flat. We're at 0.054. That's where we were last week, so no significant change.
Not going down, though. And total crypto market cap, we down too?
We're down on that one. Yeah, we are at a clean $900 billion in crypto market cap, down $50 billion in the last week. $50 billion in crypto market cap used to be noise. That's not noise anymore. We lose $50 billion in the market cap. That's, what is that? That's 2.5%.
Do you know, it's still funny, though. Less than $1 trillion.
Excuse me, that's 5%. That's 5%.
But less than $1 trillion, right? It's like, you know, the dot-com boom got to like 3 trillion in the big dot-com boom. And if you do like inflation adjusted, that's more like 10 trillion. Right. So like, you know, crypto did what? 2 trillion, 3 trillion?
3.5 at the peak, yeah.
Not that big,
right?
Compared to like the internet or the dot-com boom.
3 trillion.
Yeah, exactly. Now we're back under $1 trillion. But let's set some context here because, David, I know we're going to do a lot of macro episodes, and I think it's worth talking about macro for a minute. Our friend Kyla this week mentioned in her newsletter a meeting that happened at the ECB, the European central bankers, where all of the central bankers got together and they had a big conversation. And essentially, as Kyla says, they were like, wow, the entire economic regime is shifting from low inflation to whatever this is. Whatever this is definitely high inflation, new paradigm. And Jerome Powell is actually quoted as saying, "We understand better how little we understand about inflation." What? This is what Jerome Powell says. And it's kind of head smacking, right? Because you're just like, you have one job, Jerome Powell, and that is to like look at the historical context for this thing.
He said that out loud?
Inflation. Pretty sure he did, David. And so your job is to literally understand what inflation is. This should have caught no one by surprise. In fact, there's a lot of things that the Fed could be doing. That's not to say, though, David, that like the Fed and Powell are the only ones to blame here. Okay, sometimes you ever like all of the blame going around for inflation. People are like, oh, it's Trump. Other people are like, oh, it's Biden. Other people are like, oh, it's, you know, the war, Russia and Ukraine. It's Putin's fault. Everyone wants to blame someone. And the reality is like, yes to all of the above.
Right.
It's all of their fault. It's like there's a lot of collective fault. This was a post that I read this week that lists 15 things that inflation can be blamed on and justifiable reasons for each. Number 1, COVID. Number 2, Congress. Number 3, President Biden, the CARES Act 1. Number 4, President Trump in the CARES Act 1 and 2. Number 5, consumers who overspent. Number 6, consumers who shifted to goods. part of COVID. Number 7, the Russian invasion of Ukraine. Number 8, just-in-time delivery supply chains. Number 9, Fed monetary policy. Number 10, wages and unemployment insurance. Number 11, home shortages. Number 12, semiconductors, automobiles, price go up. Number 13, corporate profit seeking. Number 14, tax cuts and infrastructure. On number 15, the author of this post even added crypto.
Why is it our fault?
A little bit funny. They just said a lot of people made a lot of money on crypto, and then they bought things in crypto and drove up the prices of other things. But
yeah, but that's true about the equities market too. There was more money made in the equities market than crypto. I don't feel at blame at all.
Well, I'll take 1/15 of the blame, I guess. Whatever. But like the point here is, the broader point is, it's not any one thing, David.
Right.
It's like a whole bunch of things that are causing like where we are right now with inflation. And it seems like the central bankers are still not quite sure what to do with it all.
Right. I would summarize between all of those things, it really boils down to globalization. Because globalization made a pandemic global very, very quickly. It also is responsible for our supply chains, our very fragile supply chains, and then also like a Russian invasion of Ukraine that also has global impacts, just because we have a global network. So like we're super global. So like I think like 5 to 7 of those things could fall under the globalization category, and I think also 5 to 7 of those things could fall under the fiscal irresponsibility category.
Printing category.
Money printing, like payments for infrastructure that like is probably like there's a bunch of corruption in the United States, like no surprise there. So like between globalization and like fiscal irresponsibility, I think is like 2/3 of the blame, I would say, for all these.
And then you got a war.
Well, that's globalization, though, right? Because then the war, it impacts supply chains, impacts oil, blah, 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 blah.
Sure. So there's the bumper sticker. Globalization, money printing, and war caused inflation.
And crypto. And those crypto bros.
Don't forget about crypto.
It's Bitcoin's fault.
Yeah. Well, you know what? I read probably the best article I read this week was actually a letter from Dan at Pantera, and we've had Dan on the podcast in the past. He's really good from a macro perspective in particular, and he was talking about the big blame. Maybe he would say like more like 2/3 itself is actually on Fed policy. So he would weight what you just said, and he would probably agree, but I think he would weight things more towards Fed policy decisions, at least exacerbating all of the inflation that we were about to have. And 2 things the Fed did wrong. Powell, for some reason, and the Fed and central bankers around the world screwed this up in a big way. Number 1, they kept rates low for too long. We should have been raising rates a year ago, David. And that was clear.
Inflation.
Right? We went to transitory inflation. So it's number 1. That's happened at times in the past, but like that's one issue. But the second issue is even bigger. They've been manipulating the bond market. Okay? First time in history this has happened. If you look at some of these graphs from the Pantera report, you could see, look what the Fed bought. $3.1 trillion in bonds. Like buying a whole bunch of mortgages. And Dan makes the argument that like when you have an interest rate of 2.3% in the US, and when home prices are increasing by 20% year over year, the Fed is basically daring you not to buy a house. In fact, don't just buy one house, buy 2 or 3 if you can.
5 houses.
Because it's all cheap money that the Fed is effectively giving you. So by manipulating the bond market and stepping in on the housing side of things and the mortgage side of things, the Fed just pumped this thing up way beyond levels that we've ever seen, probably historically, right? And so, we've got a lot of overvaluation to get through. And Dan actually says he doesn't think that this is going to be fixed until a few things happen. 1, housing inflation goes negative, either that or unemployment rate goes up by 2%, so we're in a recession, that possibly, or core CPI gets closer to 2.5%. Core CPI is not total CPI, it's CPI less energy and food, and it's about 6% in the US. Or the Fed has unwound the majority of all of the mortgage manipulation that it's been doing. And important thing to take a look at is this is kind of a US problem, all right? The average core inflation across our peers, Japan is 0.8%, France is 3.2%, Canada 5.7%, Germany 3.8%, the average 3.4%. The US is 6%.
No coincidence that we also printed the most amount of money for stimmy checks. We also gave out the most amount in like unemployment and stimulus checks, and like surprise, surprise, we also have the highest inflation.
100%. So this has to unwind, has to make its way out of through the system, and you have to wonder too. This is something that you picked out this week. Mm-hmm. The Wall Street Journal is talking about this in a different way than they've been talking about it. What are we looking at here?
Yeah, they give that headline, rising interest rates will crush the federal budget. And like the conversation here is that if we raise interest rates and send our economy into a recession, not only is that a recession for the American economy, our own government can't pay its own debts. And so like the federal government is too indebted to suffer high interest rates. But also if we, simultaneously, that's a problem. And then if we send our own economy into a recession, where's all the tax money going to come from to pay off the debts? So like in 2022, you know like how much like the IRS, the Treasury is going to receive in capital gains tax in 2022? Like nothing, basically.
A lot less. No one's making capital gains.
It's going basically to zero. So like they're not making any money on capital gains. They're going to be able to make less money on just like other things, just because overall when the economy is down, the economy is the thing that they tax. And so if we have a recession like they have no inflows to pay their own debts. Meanwhile, the interest rates are going up because that's what we're doing to fight inflation. And so the Wall Street Journal, and it's important to note that the Wall Street Journal is saying this because like, yeah, it's an extension of like some parts of the world are just extensions of the state. There's like arguments that like the tech sector is just a surveillance arm of the state, and the media sector is just like a media arm of the state. If you just want to put this into like your conspiracy hats on, the Wall Street Journal is like very close to the state, right? And so like when the Wall Street Journal is saying like, hey, we need to defect from the policy of the Federal Reserve and say, hey, if you guys keep on raising rates, you're going to kill everything. It's important to note like where this source is. Now, this is just like one person's opinion in the Wall Street Journal, but I mean, it was published by the Wall Street Journal.
Yeah, and you know what? This is the thing I think we want to find out, and I want to find out, David. We have a lot of macro people coming in the podcast in the next couple of weeks, right? Like Lynn Alden's coming back. Who else? Luke
Grauman, yeah.
Yeah, Grauman.
We also have Travis Kling on as well. Like we have like so many different macro commentators who are going to give us
one big question I want to find out is, okay, so you have people like Dan from Pantera saying the Fed's got to raise rates like 4 to 5%, and the fact that they're talking about like 0.5% or 0.75% raise is laughable because they're already like months behind. And so they need to raise it to like 4 or 5%. As you have that. And then you have a conflicting kind of conversation going on saying the Fed can't raise rates or else the US won't be able to pay its interest payments any longer. So how does this get resolved is a big outstanding question for me that I want to ask some of these macro brains on Bankless. So Bankless listeners, stay tuned for that. A lot of conversation coming up.
The answer to that question probably is the answer that the whole entire market hinges upon right now. Like whether we are in a bear market or a bull market or like a recession, depression, or revitalization depends on the answer to that question, I would say.
Totally agree. Guys, we got some more stuff coming up. 3Rs Capital. Oof. Are they dead?
I've got some things to say, Ryan.
David's going to go through the full story, and he knows it. He's been doing his research here. Also, BlockFi lent 3Rs Capital $1 billion. BlockFi is suffering in this as well. This is the crash of the crypto banks. And lastly, we're going to talk about the Grayscale suing the SEC, what that's all about. We'll get back to these topics when we come back, but before we do, we want to thank the sponsors that made this episode possible.
Rocket Pool is your decentralized Ethereum staking protocol. You can stake your ETH in Rocket Pool and get our ETH in return, allowing you to stake your ETH and use it in DeFi at the same time. You can get 4% on your ETH by staking it with Rocket Pool, but you can get even more by running a node. Rocket Pool is the only staking provider that allows anyone to permissionlessly join their network of validating Ethereum nodes. Setting up your Rocket Pool node is easier than running a node solo, and you only need 16 ETH to get started. You get an extra 15% staking commission on the pooled ETH that uses your node to stake. You also get RPL token rewards on top. So if you're bullish ETH staking, you can boost your yield by adding your node to the decentralized Rocket Pool network, which currently has over 1,000 independent node operators. It's yield farming, but with Ethereum nodes. You can get started at rocketpool.net, and you can also join the Rocket Pool community in their Discord. You can find me hanging out there sometimes in the chat, so I'll see you there. MakerDAO is the OG DeFi protocol, the first DeFi protocol to ever exist, even before we called it DeFi. MakerDAO produces DAI, the industry's most battle-tested and resilient stablecoin. Using Maker, you don't need to sell your collateral if you need liquidity. Instead, you can spin up a Maker vault and use your collateral to mint DAI directly. With Maker, the power to mint new money is in your hands. And there's something new in the MakerDAO ecosystem. Every time a new MakerDAO is opened, the owner can claim a POAP, which contributes funds to One Tree Planted, an organization with ongoing global reforestation efforts, creating a world where digital participation and the health of our environment can live side by side. Soon, Maker will be present on all chains and layer 2s, bringing the biggest and best DeFi credit facility to everywhere there is DeFi. So follow Maker on Twitter @MakerDAO and learn from the oldest and most resilient DAO in existence.
All right, guys, we are back. Going to start with the crypto contagion, the 3AC Capital Meltdown. The story continues into this week. Here is a story from the Wall Street Journal. Crypto hedge fund 3AC Capital ordered by court to liquidate. David's going to go through all of the details, but just a little bit of background on this. 3AC Capital is absolutely massive during the bull run. 10 to 18 billion maybe assets under management. It's still kind of unclear, but a whole lot of money and a whole lot of prestige through this group. And now there's a complete meltdown. David, what's the story here? Take us through the timeline of what happened.
Now that we have seen the fallout from some of this, we get to start to peer inside the black box that is 3AC Capital. All of this really started, and this behavior started at the very beginning of the bull market. For those that were here around the beginning of the bull market, the Grayscale GBTC trust, it's GBTC is one-to-one towards Bitcoin, but there's no redemption window. And this is because we cannot have a Bitcoin ETF because of the SEC. They had to make a trust out of things. And so you could come to the Grayscale GBTC trust, you could deposit 1 Bitcoin, you would be issued 1 GBTC share, and then 6 to 12 months later, you were allowed to liquidate that share on the open market. And this is for accredited investors only. As the bull market got underway, and institutions did not have Coinbase accounts or FTX accounts, they used the Grayscale Trust to gain access to Bitcoin. And since they're not one-to-one redeemable, since there's not a credit window, the Grayscale GBT's trust could have a premium. I think the premium got as large as 148%, as in 1 Bitcoin was, 1 GBTC share was worth 1.48 times a Bitcoin, when it should trade at par, but it doesn't because it's not an ETF.
So it's a nice
trust.
arbitrage, right? It's a 48% arbitrage right there.
If you can take the 6 months illiquidity window.
Right.
So here's what 3AC Capital would do. They went out and borrowed as much Bitcoin as possible from the market to turn it into GBTC shares to milk this premium. They would borrow Bitcoin from some source and they would put it into Grayscale. 6 months later, they would have this 48% arbitrage, and that number would fluctuate.
Because this premium would never go away, right?
It was so persistent for so long that's what people thought. But then even the most average person will if there's a premium, people are going to milk it. And 3AC Capital were the people milking it. The thing is, Ryan, they weren't selling their GBTC to capture it on premium. They were using it as other collateral. So this starts off by 3AC Capital borrowing as much Bitcoin as possible, as much Bitcoin as the market would lend to them from any lender facility possible, which is where this contagion starts. And so they put all their BTC that they are borrowing into the Grayscale GBTC trust to get GBTC back. And then they start using that GBTC as collateral to borrow stablecoins. So they're now borrowing stablecoins based on their GBTC, and they started to invest in order to try and get the alpha, try and get the premium to start to pay some of their loans back for borrowing Bitcoin in the first place. They invest bigly into Terra. We all know what happens there. They bought a bunch of vested AVAX tokens. AVAX is down bad, and they're probably still vesting anyways. And they started to take more and more capital from wherever they could get it, because they also have loan and interest payments to get back. Right? They get a $660 million unsecured loan from Voyager, which is a crypto exchange, not a lending facility, but somehow they convinced Voyager to give them a $660 million loan, unsecured loan. They get a $1 billion loan from BlockFi, over collateralized. I believe the numbers were some combination of Bitcoin and also GBTC shares. We'll talk about that later on. So they get $1 billion loan from BlockFi with a 30% over collateralization. So like $1.3 billion inside of BlockFi, they get a $1 billion loan, and they go and speculate on the market with that. They get caught up in the staked ETH trade, like trading the merge, thinking that the merge is going to happen, like everyone's going to buy into staked ETH, but then instead of the merge happening, markets go down bad because of Fed risks, and like their staked ETH, instead of being worth 1 ETH, turns into being worth 0.96 ETH, and they can't redeem that because that's how staked ETH works in the first place. And so also, like, there's illegal stuff happening too. And so the Singapore Central Bank just gave 3 Arrows censures, I don't know what that means actually, 3 Arrows Capital for alleged misleading and false disclosures. And there's evidence for this that's going around on crypto Twitter and throughout the markets. There's evidence that they falsified records to lenders in order to access more capital. So fraud, basically. They committed fraud so that their balance sheet could look healthier so they could get more and more loans out from other people. There's also public reports that 3 Arrows Capital allowed other trading firms to use their account on crypto exchanges to trade through their accounts, right? 3 Arrows Capital, they had billions of dollars. They could negotiate with crypto exchanges to like, hey, charge us less fees on your exchange because we're going to put a bunch of volume there and we don't want to pay those fees. And the crypto exchanges are like, yes, totally. You guys put all this volume through our exchange. We'll totally charge you less fees. And then 3 Arrows Capital let other people put money into their account to trade on their account on crypto exchanges so that these third parties could access less fees as well. You know what that is, Ryan? That is an unlicensed prime brokerage with Bank Secrecy Act and wire fraud. These are criminal cases. And then there's also representation that there's also evidence that they represented to OTC desks. They had relationships with other entities and other OTC desks that they didn't in order to like presume some legitimacy to other OTC desks. So they start off with this like very normal, like, I'll just borrow Bitcoin to get this GBTC trade premium. They never sell. They never manage their risks. They instead of closing their risks, they just open up more loans on those risks. Then they somehow like give this crypto Twitter like a brand about themselves that they're huge chads who make a ton of money. And so people loan them even more money. They took money in from DeFi treasuries, they raise $50 million. They're sitting on it. They don't need to go get yield during the bear market. So somehow 3 Arrows Capital convinced them, just give us your treasury and we will give you like this percentage. Meanwhile, they probably like stick it into something like Terra and get 20%, and then that thing goes to zero. So like a bunch of DeFi treasuries are down to zero because they trusted 3 Arrows Capital to give them the yield. And so like not only did they are one of the sources of Contagion because they borrowed from Voyager, they borrowed from BlockFi. If they didn't borrow from Celsius, they are 1 degree away from borrowing from Celsius.
Well, what's crazy about this is like this is the point retail starts lending to 3 Arrows Capital without knowing it. So if you're putting funds into BlockFi, right, and you're generating some sort of yield, you were effectively lending to 3 Arrows Capital. Now, this is an over-collateralized loan, right? Of course, so people think that's super safe. But we'll talk about why that wasn't so safe with GDBC a little bit later. But I think the important point here is it wasn't just institution to institution. This became a retail phenomenon when you're depositing funds into these crypto banks like a BlockFi or Celsius. You are actually giving some funds to Zoo and the 3 Arrows Capital team.
And that truth is rampant throughout the industry, right? Like Voyager, a crypto exchange, not a lending desk. Customers would come and deposit their money into Voyager exchange to do normal exchange stuff, and Voyager lent that money out to 3 Arrows Capital. So 3 Arrows Capital is at the center of the contagion. They are the contagion, Ryan. They had their tentacles in every single entity that would ever lend them money, either over collateralized or under collateralized. And so like it almost doesn't matter where retail entered the industry, money flowed into 3 Arrows Capital because they took every single lending opportunity that they could and maxed that account out. That is crazy.
Does this blow you away? Like it feels like they just made all of the noob mistakes in like one market cycle. They just did them all. It's like check the box. I'll think the GDPC trade goes on forever. I'll get into Terra and see if that. I'll do this ETH staking trade, expecting like some sort of timing on the other side of this. I'll do the alt layer 1 trade with Avalanche and all of these other things. Like, they're just checking the boxes of all of the mistakes a noob would make to lose their money during the bull market.
Right. And like they made such a staggering amount of money during the upside of the market. Part of that was on the backs of they borrowed it, and then like, you know, it works in bull markets, and then they lost it all in the bear market, right? And so like, I can't remember where I heard this quote from, but like the venture firms or like, you know, hedge funds that do extremely well in one cycle aren't going to be around it for the second cycle, because if they were levered up, if they were levered up on the way up, they're also levered on the way down, and they don't make it the second time around. So like having too strong a performance on the upswing means you're getting liquidated on the downswing, and that's definitely what happened. You want to see the cherry on top of this whole entire saga, Ryan?
Yeah, give me the dirty
Suzu has a $50 million mega yacht that is being seized, and I can't remember what the name of this yacht is, but it's some like internet meme. This is a triple-decker yacht that Suzu put a down payment on somewhere in like, I think it's the British Virgin Islands or somewhere, who has also made a court order to liquidate 3 Arrows Capital, because that's where 3 Arrows Capital, I believe, is domiciled. Yeah, so like this is something that Suzu still has, is this like $50 million yacht that he has his down payment on, wow. Which is absolutely crazy.
Absolutely crazy, absolutely brutal. And it sounds like the authorities are stepping in, nation states, British Virgin Islands are ordering the liquidation. So like the collectors are coming probably for that yacht as well. I would imagine all the assets are going to get liquidated. It's pretty
Ryan,
crazy.
This is not a matter of like 3 Arrows Capital going under and like we're not seeing 3 Arrows Capital again. Like, this isn't happening yet. This is still in speculation phase, but this is a criminal enterprise. This is a criminal enterprise. Well, like, Kyle Davies and Suzu are, in my mind, I'm not a lawyer. I do not have insight to these things. Do not listen to me. They are criminals on the run.
Yeah, it definitely is starting to seem that way, and unfortunately, it's cost the crypto market a lot in this cycle, including retail. This is a tweet from Vitalik. What are we looking at? This is not him weighing in on the whole controversy, but I think he's maybe being a little subtle here.
He's being a little snarky.
What's
for good reason. Vitalik says that there are far more honorable ways to burn $50 million to impress people than buying a super yacht. They burned way more than $50 million, by the way. Like becoming a Gitcoin Grants matching partner. Here is the matching partners for our current round. So if you want to look around in the space and like look who is still capitalized and capitalized to the point of donating to public goods, it's the people in this graphic. We got Unlock Protocol, we got the Graph, we got Radical, we got Aragon Project, Zora, Figment, ZK Validators, Cello, Yearn Finance, ENS Domains, Protocol Labs, Chainlink. Sorry if I'm not writing all these. Polygons there, Aves there. These are the people that are so well capitalized that they are still donating money to public goods. Nice job, guys.
Yeah, there we go. And you know what? This is just, I hope this is part of the cleansing process of getting rid of the excess of like greed and leverage and margin that was going on during the bull market. David and I aren't like celebrating the downfall of 3 Arrows Capital. At least I'm not. Maybe David is a little bit. No, he's not. But like, this had to end. This whole spirit of like degen, short-term traders dominating, like this had to end, and we had to get back to the fundamentals of what we're actually building in this industry. And so I feel like from that perspective, this is the hard medicine the crypto industry and everyone in the crypto industry has to swallow, because the stuff we were doing in this cycle, and by we, I don't mean bankless listeners necessarily, but collectively the industry was not sustainable, was not healthy, and had to stop at some point. And so better now than later, right? And I think this is a healthy thing. Well, let's talk a little bit about BlockFi, because the contagion has spread to BlockFi. You said
that was part one of the contagion.
Yeah, they had a $1 billion loan outstanding to 3 Arrows Capital, but it was collateralized by $1.3 billion or something to that effect. How does this even happen? How does the contagion spread when you've got a collateralized loan to BlockFi, David? How does this spread into BlockFi's potential bankruptcy or insolvency right now is what it's looking like?
Well, so $1.3 of over-collateralized loan for a $1 billion loan, like that's sure. but like crypto prices went down by like 60 or 70%. And 3R's Capital didn't have any money to top up their loan. So that $1.3 billion in collateral was probably below the $1 billion loan that BlockFi gave 3R's Capital.
Well, my understanding is BlockFi, there was like a $1 billion or something loan, right? That BlockFi had with 3R's Capital. They were lending them, and they had, we'll call it $1.3 billion over collateralization of that. A whole chunk of that was Bitcoin. And that could be collateralized as prices go down. BlockFi is going, that could be liquidated. As prices go down, BlockFi is going to liquidate that entire position. And my understanding is they did. But another chunk of that, of the $1.3 billion that was supposed to collateralize this loan, was actually GDBC. And that is not liquid in the same way that Bitcoin is liquid, right? And so my understanding is that's really where BlockFi has gotten hung up on the GDBC collateral that was not worth what it seemed like it was worth in the market. Right. And that's the part that really, punched him, knocked him out. I mean, there's other things that BlockFi was probably doing from a risk perspective, but this was certainly a big one and has led to BlockFi. There's been some purchase talk. Yeah. What's going on there?
Yeah, there is a tug of war. There is a race to acquire BlockFi. And so this is a race between Morgan Creek Digital, which already has a bunch of BlockFi equity to begin with, and then also FTX. So FTX gave BlockFi, I think, a $200 million credit revolving door facility, I think, a couple weeks ago. Yeah. 250 million, credit agreement, and so that allows for users to withdraw their money. As far as I know, users can still withdraw their money, and that comes off of a credit agreement with FTX. And I think what that means is that FTX has the ability to purchase FTX shares from the equity holders at basically from what BlockFi was previously valued at, basically free. At this current valuation, BlockFi is valued at $25 to $50 million, which is an extremely low number from where they came from. It's basically
wiping them out. It's basically you're taking all of the equity holders of BlockFi, whether that's the founders or employees or previous investors like Morgan Creek, you're wiping them out. But what FTX was doing here is placing its debt to BlockFi as more junior to depositor debt. So that means they were kind of protecting depositors. So if you were a regular user and you had deposited funds into BlockFi, you want to make sure you're going to get that money out. And you want to get that money out before, in a liquidation event, FTX gets its money out. And so that was the benefit that this was providing. And I actually think it's laudable that BlockFi is trying to look out for its users. Maybe they're also trying to just prevent criminal charges or something like this, right? So maybe it's not all kind of moralism here. Maybe they're actually trying to protect themselves here. But depositors getting protected in this scenario is a good thing. It's not clear that that's what's happening in Celsius. It seems like depositors are probably going to take some haircut when the Celsius dust settles. And so that at least was good about FTX. But then Morgan Creek is why should BlockFi only be worth $25 million? Right. This is somebody coming in and basically scalping BlockFi when they're down, and they're trying to raise some emergency capital to value the company at a higher amount and provide that 250 million injection. I think that valuation, if Morgan Creek deal goes through, is something like $500 million. So far higher than the FTX deal. Right.
But like you said, that puts the equity holders, current and new equity holders of BlockFi, above depositors. So this is not only a tug of war between FTX and Morgan Creek. This is a tug of war of who gets bailed out first, I guess is maybe.
Yeah, I don't know if that's the case. I don't know all of the details of the Morgan Creek and what position it puts depositors in. I think Morgan Creek is trying to also protect depositors. That's not clear to me, but. Yeah, I guess there's a lot of dust to still settle in the BlockFi case. But in good news, I actually had some funds. I know. Did I confess 2 weeks ago that I had some funds on Celsius? Again, yeah, you did. Ryan likes to try everything. Ryan tried some centralized lenders. including Celsius, Nexo, a few others, just a small amount of funds, right? Because you got to
keep an eye on those crypto banks out there.
You got to keep an eye on it.
Got to keep an eye on
It's not looking good for my Celsius deposit, all right? But I was actually able to withdraw from BlockFi in the last few days. And so that's at least a good sign. That's a stress test of some sort. They're not freezing accounts yet. So it doesn't seem to be it's in as bad a position as Celsius is. I have a BlockFi credit card too. I hope that's going to be okay. What do you think, David?
Well, if it's a credit card, it's probably going to be fine. There's a really good article out of the block that really summarized these whole things, saying 4 big takeaways from a leaked investor call, kind of recapping what we've already said. BlockFi is currently being valued at less than $500 million. If the FTX deal goes through, significantly less than $500 million. We're talking about $25 to $50 million. If the Morgan Creek deal goes through, maybe it's around that, give or take. Morgan Creek Digital says BlockFi's loan to 3 Arrows Capital was $1 billion, and the collateral on 3 Arrows Capital loan was 2/3 Bitcoin and 1/3 GBTC. During the call, yes, the FTX deal gives the firm the option to buy BlockFi, but not if Morgan Creek can get there first. And then, of course, obviously, more layoffs may be in the works at BlockFi. It's kind of what I would expect. But Ryan, I would like to take this opportunity to go backwards in time about 1 year to June 2021, when BlockFi was on the verge of going public, right when the SEC came into BlockFi and told them that they could no longer accept new customer deposits in their existing like lending products. And BlockFi fought them on this. The SEC wanted them to close their existing lending products. BlockFi fought them on this and said, hey, we just won't accept any new inbound, but current customers get to be grandfathered in. That's the settlement of that whole thing.
Can I just...
BlockFi then...
Can we just say, like, is the SEC saving the day here? I mean,
they're
like...
not doing that.
They weren't wrong about this, were they?
They weren't wrong. No, not at all. And so at the same time, BlockFi wanted to go public. And so it was going to raise $500 million on their Series E, which would put them at $4.7 billion valuation. $4.7 billion valuation a year ago.
12 months.
1 year ago. Fast forward to today. BlockFi is on the market for $25 to $50 million in valuation. Oof.
Yeah. That's down bad, and it's unfortunate that retail has been involved.
Yes.
And again, it's people depositing into BlockFi. You see the crypto contagion. BlockFi issues some loans to 3 Arrows Capital. 3 Arrows Capital goes bust, and eventually that flows back to retail, right? This is the problem. I think this is a great contrast point with DeFi did quite well during all of this.
Right.
A lot of lending going on in DeFi, and when crypto goes down 70% to 90%, right? A lot of the CeFi lenders are caught like insolvent. And yet DeFi unwinded very gracefully with a highly efficient market. We're going to get more to a take on that in a little bit, but it's quite the contrast.
The juxtaposition is just so clear.
Exactly.
It's
Could
so
it be
clear.
more clear?
And as a quick, fun little side quest before we go on to the next thing, the SEC thing, there was an article out of the block that states that FTX was interested in making a deal with Celsius, kind of in the same way that they're making a deal with BlockFi. But then they looked at Celsius's balance sheet and they were like, oh, no way, we're out of here. So declined buying Celsius once they took a look at their balance sheet, which is not a good sign. Allegedly, according to a source, Celsius has a $2 billion hole in their balance sheet. So like no one would like to take responsibility of that one.
David, did you see that meme? It was like a person reaching down to someone's hand and they're in the water and looking like they're drowning, and it says FTX, and it's like, I'll help you, and Celsius is the person drowning in water. Then the person goes down under and it's only the hand. And like the FTX caption is like, oh, you're too deep. See you later. Sorry. It's kind of what's happening. I mean, Celsius is in a far worse place than BlockFi was. And so we're kind of seeing the quality of these crypto banks right now, right? We have some that are still left standing.
Right.
Nexo is still left standing.
Right.
JUNO, which we talked about earlier, they're still left standing.
Right. Yeah.
Coinbase is fine. They're going to be totally fine. CZ, Binance, they're actually like buying things. FTX, they're buying things right now too.
FTX is in a great position right now.
Yeah, they're in a great position. Anyway, so, okay, what does the GDBC thing have to do with all of this? We've mentioned it a few times, and Grayscale is actually suing the SEC. They are the creators of the GDBC product. Can you explain what's going on here for us, David?
Right, and so the GBTC discount is something like 30 to 35% at the moment, as in the GBTC is worth only 70% of what one Bitcoin is worth.
And a lot of people... GBTC is a product that you can get in your retirement account, right? Retail can buy in their retirement account because we don't have an official ETF in the US. We have to use products like GDBC, which is a trust.
Right, and it's like almost inarguably an inferior product. Like it's supposed to represent one Bitcoin, yet it's only representing 70% of one Bitcoin. And there's like a 6-month illiquidity lockup period for accreditor investors between when they deposit Bitcoin and then when can they redeem their GBTC. So like a lot of capital lockup, a lot of capital efficiency. During a time where crypto markets go down like 75% on average, there is a discount, a 30% discount on GBTC and a illiquidity lockup phase. When people need liquidity the most, this trust model sucks it all dry. And it's no fault of Grayscale at all. It's the SEC's fault because the SEC won't let them turn this into an ETF. And so the SEC rejected Grayscale's spot Bitcoin ETF application, which from all the commentators like Jake Stravinsky and others that I'm aware of, say like there's literally no reason why the SEC should deny this. This is totally above board. They should accept this. But for some reason, people just got the feeling that the SEC was going to deny it. And so the day that the SEC said that they are denied the Grayscale conversion of the trust to an ETF, Michael Sonnenshein tweets out, we've filed a lawsuit against the SEC, $GBTC, ticker sign GBTC, 15,000 likes, which is a big number. And so they also released this PR report that talks about the details. Nice like there. Grayscale Investment initiates lawsuit against the SEC. We're going to court. Crypto is taking the SEC to court, and everyone, I think, in my opinion, should be behind this conversion of the trust into an ETF because it would immediately restore 30% of like capital that should be there in the GBTC token, and it would allow a 1-to-1 redemption window between GBTC and Bitcoin. So many people would get much more liquidity. So many people would become much more capitalized in a time, in a place in the market where people need it the most. So, statement out of Grayscale says, the SEC is failing to apply consistent treatment to similar investment vehicles and is thereby acting arbitrarily and capriciously in violation of the Administrative Procedure Act and Securities Exchange Act of 1934. There is a compelling and common sense argument here, and we look forward to resolving this matter productively and expeditiously, says Grayscale. Take him to court, Grayscale. Go do it.
Look, indirectly, the SEC cost retail a lot of money, right?
Much.
Because of this market inefficiency. Now, I'm not saying like Suzu's actions and BlockFi's risk actions caused all of this, but I am saying that there's an inefficiency in GDBC and the Bitcoin spot price that doesn't actually need to be there and wouldn't be there if the SEC just allowed Grayscale to convert it to an ETF. And so it's just kind of an example of like sometimes regulators in the SEC are helpful to the industry, right? And it's like, okay, we have a centralized lending provider, all right? We need some regulation. We need some windows into that. We need some auditing. We need some insight into that, okay? So like there should be a role for regulators in, looking at Celsius in depth and looking at BlockFi in depth and making sure that like they're on the up and up, okay? That's one thing that we could benefit from. By the same token, we also want from the SEC an ETF for retail. Like, so why can't you get rid of, like, help us with the things we need help with as a crypto industry, but then also give us the things that will protect retail that we need, like an ETF. Give us a safe space to play. And of course, like this kind of silence on DeFi from regulators and almost a hostility towards DeFi, an undue hostility towards DeFi, and it's kind of a TBD. We don't know if we're going to allow that or not, right? When DeFi is part of the answer to this, right? DeFi markets performed flawlessly, transparent, on-chain. It all worked. We did the same liquidations that the CeFi lenders did, except DeFi didn't screw anyone over. It actually performed exactly as it was supposed to. It's because our regulations are based in smart contracts. So the SEC and other regulators could view DeFi as part of the solution here. and they're not quite there yet. I'm hopeful it gets resolved, David, but like I just feel like anything with regulators is kind of a double-edged sword, because we want you guys here to help us with the scams and like the clear like things that we need help with, where retail is getting screwed over, but we don't want you to like say the whole thing is off limits and hamper the entire industry and try to shut it down and get it out of like the US, because part of the reason we're doing these things is because we are routing around dumb regulation that doesn't work for the people. That's my rant on the SEC, David.
Love it. So going back to the market section where we talked about like the 15 different sources of inflation, like here's the source. Here's like the 4 sources for the contagions in the crypto industry. We had like irresponsible centralized lenders, both unsecured and secured. We had 3AC Capital taking advantage of that. We had an inferior product out of Grayscale with the GBT Trust, again, to no fault of their own, and an SEC unwilling to work with this industry to provide clarity or allow this industry to move forward in a way that protected retail investors and allowed these markets to do efficient and orderly clearing of liquidations. Like the SEC, which is their mandate, got in the way of that. So like the contagion of crypto, the reason why it's so big is like 3 or 4 different interwoven reasons, like some degeneracy culture, like central, like the same reasons of like DeFi people like talk crap about CeFi stuff is like black box, human folly. Like you can't manage stuff, so you let the code do it. And then because of that inferior stuff, you have like 3AC Capital who like exploits every single possible like way to get money out of it. Like that, congratulations. That is the bear market of the last 6 months. That's the full context.
We're all on the hook for it. It's a lot of blame to be shared across all groups doing this. David, we got more to cover, man. We're going to talk a bit more about Maker's DeFi governance, the biggest Maker proposal in history.
Most controversial,
also, an update on Arbitrum Odyssey. This is their latest update and what's going on there. Guys, we'll be right back, but before we do, we want to thank the sponsors that made this episode possible.
The Layer 2 era is upon us. Ethereum's Layer 2 ecosystem is growing every day, and we need Layer 2 bridges to be fast and efficient in order to live a Layer 2 life. Across is the fastest, cheapest, and most secure cross-chain bridge. With Across, you don't have to worry about high fees or long wait times. Assets are bridged and available for use almost instantaneously. Across's bridges are powered by UMA's optimistic oracle to securely transfer tokens between Layer 2s and Ethereum. Across its critical ecosystem infrastructure, and Across V2 has just launched. Their new version focuses on higher capital efficiency, Layer 2 to Layer 2 transfers, and a brand new chain with Polygon, all while prioritizing high security and low fees. You can be a part of Across's story by joining their Discord and using Across for all of your Layer 2 transferring needs. So go to across.to to quickly and securely bridge your assets between Ethereum, Optimism, Polygon, Arbitrum, or Boba networks. There is a brand new staking feature in the Ledger Live app today. We all like staking the assets that we're bullish on, and now you can stake 7 different coins inside the Ledger Live app. Cosmos, Polkadot, Tron, Algorand, Tezos, Solana, and of course Ethereum. With Ledger Live, you can take money from your bank account, buy your most bullish crypto asset, and stake that asset to its network, all inside the Ledger Live app. Through a partnership with Figment, Ledger also lets you choose which validator you want to stake your assets with. And Ledger is running its own validating nodes, offering a convenient way to participate in network validation, and it even comes with slashing insurance. Ledger Live is truly becoming the battle station for the bankless world, so go download Ledger Live. If you have a Ledger already, you probably already have it, and get started securely staking your crypto assets. And we are back. Longtime Bankless listeners will know that MakerDAO holds a very close place in my heart. I think it's a very cool project. And there was the most contentious, most controversial governance proposal over MakerDAO just happened. The highest amount of all MKR showed up to vote. And it was neck and neck up until the very end. Here's GFX Labs putting everything into a nice summary. 30% of all token supply voted, which is crazy to think because like so many MKR are scattered around like all of DeFi. 30% of them showed up. Voting was neck and neck until the last 2 hours. The vote was to add a new core unit to oversee the DAO's onboarding of collateral assets and also form a specific framework for growing the protocol. This core unit also came with a hefty price tag. Basically, the framework was a little bit more of kind of like a constitution-ish about like what MakerDAO needs to do, where it needs to go, the direction it needs to go in. And it was a pretty
big turn off of its current path. And so, unlike the thread continues, unlike most governance votes, two distinct sides developed. Those who wanted to see more organization and control voted yes, which is like the TradFi VC real world assets camp. And then the no's, which are like the kind of the core MakerDAO community, opposed the price tag and didn't really like this specific direction and wanted to continue with Rune, the founder of MakerDAO's, his end game plan. That's the name of a post that he wrote. And so, after the dust settled, it ended up being that the TradFi and VCs did not make the proposal. They got outvoted by about 15%. So the MakerDAO decided to go with a continued endgame plan. But the idea here is that there's a tug of war going on over MakerDAO, and no one thinks that this is over. And so after this, Hasu actually put a very interesting thread together about his vision for the future of MakerDAO. Hasu was on the yes side of these things, like the TradFi and VC side of things. And like I know TradFi and VCs are generally heard as a negative term, like abstain your opinions on that word in this particular context because these are crypto VCs who have opinions. Hasu puts a tweet out that says, I just propose a series of simple governing changes to MakerDAO that address many problems that exist in governance today. This includes a general lack of vision and strategy as well as low accountability for maker holders. Hasu has been thinking a ton about DAO governance lately. And so he puts these this proposal into place that basically streamlines governance because there are so many things that's going on with MakerDAO that everyone has to vote on all the things, and there's no centralization of decision making. Basically, it's really taking the DAO at heart. So he puts these vision, strategy, tactics, and implementation categories together and promotes 3 different ideas that just streamlines all of these things. And so if you are into the world of DAO governance and on the frontier of that, pay attention to what Hasu wrote. We're gonna get him on the podcast soon, but basically there's a very controversial MakerDAO vote pulling MakerDAO into 2 different directions. And while this new direction did lose, I don't think it's going to be the last time we hear from this.
Well, I do think it's healthy, honestly. I think the 2 directions are kind of healthy, right? So it sounds like VC investors are just hey, we want more accountability. And our method for solving that is let's install a core unit, a new management team effectively, some more centralization, right? And here's the community saying, no, everything's good. We have a plan. Let's keep going in the direction we're going. And this is a healthy tug of war, I think, because the other reality is everyone who owns the Maker token does have another vote beyond this governance vote. And that vote is just to sell their MKR tokens if they no longer believe in the direction of the project. And so any investor in MKR tokens could do that at any time. And anyway, it's good to see. I do think sometimes communities veer on the other side of the whole decentralization debate too much, and they're no structure. All structure is bad. All leadership is bad. Any kind of token mechanic that increases the value of the token is bad, and that is obviously not the right choice either, right? It's I would love to see a bit more investor action in something like the Uni token, for example. I would love to see it there. Anyway,
let's turn on that fee switch.
Yeah, exactly. I think it's all healthy, and I'm anxious to see how this all plays out, but it's playing out transparently in real time. Here's another governance vote from Lido. What's going on here, David?
Yeah, this is not the end of the DAO governance saga, also related to Hasu. There was a proposal from the Lido DAO to itself to say, hey, should we cap ourselves? Should we limit how much Ether is in Lido? Because Ether is dangerously close to passing a threshold that would allow Lido to have undue control over the entire Ethereum network. I wouldn't actually be surprised if that limit has already been passed. So Lido submitted a governance proposal to itself saying, hey, should we cap ourselves? Should we prevent more Ether from being deposited so we don't grow too big? And surprise, surprise, 99.81% of Lido said, no, we should not cap ourselves, which makes sense, right? Lido's not going to say I think that we should make less money because our product is too good. They're not going to say that. And so Hasu, again, co-authored another proposal for Lido staked ETH governance, which I think is really innovative, and I think it is a model that we can take out for other DAOs, right? And so the idea here is that Lido governance will stay Lido governance, but staked ETH holders, Ryan, get the ability to veto any Lido DAO proposal. So they don't, staked ETH holders don't get to say yes. they don't get to submit new proposals. But if a new proposal is submitted by Lido DAO governance and the Lido DAO governance says yes, then staked ETH holders can come in and say no.
That's
which I think
cool.
is really cool.
Nice check and
That's
balance.
really, really cool. Yeah, so like the staked ETH holders get one tool, which is no. You get to veto.
Veto power.
Right. And so I think that's great. I think that's really cool.
That's really smart. And that's the kind of evolution which I'm most excited about in kind of DAO governance is new ideas like Hasu's idea here, and to see how that emerges. No surprise, though, that Lido would vote to self-limit, right? In fact, the original proposal, I mean, I don't think anyone was calling for a self-limit. Like, even Vitalik was not talking about a self-limit. Right. He was talking about, like, raise fees.
Raise the fees.
After you have a certain percentage of market share. So even the original proposal seemed kind of like constructed in a very binary way. That was a little bit weird. But, of course, token holders are going to vote in their own self-interest. Right. David, let's talk about some Layer 2 stuff, too. So,
Layer 2 stuff.
Odyssey from Arbitrum. What is Odyssey, and what happened with it this week?
Right. So Arbitrum Odyssey is basically this journey around the Arbitrum ecosystem where you would go and do some things and you would get some NFTs. The first week of the Odyssey was Bridge Week. So you bridge onto Arbitrum and you would get an NFT if you did that. And so they were going to go from Bridge Week into like App Week, which is going to be the remainder of the Odyssey, like weeks 2 through 8. But as soon as App Week got started, like Arbitrum got congested because so many people came onto Arbitrum during Bridge Week. As soon as I started doing App Week stuff, they got congested. And that's because a lot of the applications that was in this first week was like heavy computation stuff. There was a lot of, what was the app that was being used? It was GMX, which are perps and leverage, which just require a ton of computation. And so like, simple transfers on Arbitrum, like that's not gonna clog the network. But like as soon as you do like computationally heavy stuff, that will start to clog the network. And so they are putting the Odyssey on pause until they release Nitro. And once they get Nitro back, once they get Nitro online and they get the Arbitrum like Layer 2 updated to this new update, then they're gonna resume the Odyssey and the Odyssey shall continue. I asked some of the Arbitrum folks, like if you could give us some numbers on like what the scalability of Nitro. And they said, a nice, easy to interpret number of 7 Ethereums. As soon as the Nitro update is online, Arbitrum is going to be about 7 Ethereums. And like all Layer 2s, like these updates are just the beginning. And so like going to where Arbitrum is now, which I think is like 2 to 3 Ethereums, going up to 7 Ethereums, nice big jump. But then like there's also, again, EIP 4488 that increases the scale as well. And so there's also like some crazy numbers that we have. There's a Dune analytics page, which I'll have you pull up, Ryan, which just showed the sheer magnitude of people that went on to Arbitrum during week 1. 250,000 new bridgeors, at least bridging addresses, that happened on Arbitrum. So 250,000 addresses went onto Arbitrum in 7 days. And like that wasn't congested at all, just again, because like simple transfers are totally fine.
So can I ask you, David, did they just pause the Odyssey itself, right? They didn't pause the network or anything like
God,
this.
yes, no. Network is doing just fine. Like the congestion's not even here at this point.
They just paused their marketing program basically because they were like, oh, too much too soon. We want to deploy Nitro first, which is going to 7x their network, and so that's the reason why the pause. Why are people doing this for worthless NFTs, David?
I mean, okay, so like the simple take is that if you get all the NFTs, you'll get all the airdrops.
Oh,
like,
okay.
That makes
so these are like participation NFTs, right?
Participation NFTs. Like it's so obvious that I'm kind of skeptical on it. It's like, yeah, like Arbitrum Odyssey, we're gonna give you NFTs so you can be on a list of people who got the NFTs.
Just because it's obvious, dude. ETH is obvious right now, the merge. I think that's what's totally going to happen. Again, none of this is, we don't know anything from the Arbitrum team about any of this, but like what's really nice about this is that if they're giving out NFTs for real things that people are doing, they get a pretty clean whitelist of actual individuals doing real things in the network.
Well, not if you farm it though.
So people are just farming NFTs instead?
Right, farming NFTs, that's a concept.
Yeah, I bet they'll find a way around that. But it gives a nice base of additional data to differentiate for a future airdrop, which it's got to be happening, man. Got to be happening.
Oh, well, the ARB token is coming for sure. I've been trying to figure this out, Ryan. What is the Arbitrum token going to be called? ARB or ARBI or something else?
Arby?
Arby's kind of a cool name.
Like Arby's? It makes you think of fast food. It's like Arby's. Arb is cool, though, because it's like,
pretty cool.
arbitrage.
Right.
ARB. What is Optimism?
OP.
What's
OP?
It's just OP, right?
Yeah. Which is, I think, super hot.
Could be AR.
AR versus OP.
Sounds like a gun.
Oh, yeah. That sounds like a
I don't
gun.
know. We'll have to see when it comes out.
I do think Optimism won the name debate or the name fight, but
OP is
that's
nice.
just my take. OP's pretty hot.
Okay. Speaking of Optimism,
OP,
they're going up too. Trading activity surges on Optimism's layer 2 as total locked value doubles. David, this is a layer 2 beat. Look at this. Optimism now number 2, ahead of DYDX in terms of total locked value on the Rollup. The number 2 Rollup behind Arbitrum, which has $1.96 billion. It seems like the recent OP airdrop has helped in terms of getting more value locked inside of this platform. Also impressive that this is happening during a bear market. So Rollup's continuing to do well even despite a bear market. Any other takes here?
I wonder if the minus 11% flowing out of DYDX is a reaction to their DYDX chain, or if just people are scared in the bear market, so they're not trading leverage.
I don't know.
Could be.
I'm tempted to say it's kind of noise for now, but that's going to be one to DYDX no longer going to be on L2 beat, David. You sad about that?
Right, yeah. This is going to be an L1 beat.
Yeah, it'll be back to
there
its
isn't
L1
an
beat.
L1 beat, yeah.
Yeah, by the way, guys, we had an episode with Antonio where they talked about, earlier this week, they talked about their transition to an app chain for a layer 2. You go listen to that episode. I have some thoughts coming out of that episode.
Got some thoughts,
I won't share them all here, but in the weeks to come, maybe we'll share some of those thoughts. But anyway, great episode if you want to hear their rationale for doing this. ETH stuff, merge stuff. When merge, David? July 6th, something's happening.
We still don't know that. The July 6th is not when the merge is happening. That is when the Sepolia testnet merge is happening. And so that's coming up. That is the second of 3 testnets that we must get to get to the actual merge. The second one is happening on July 6th. It's going to be live streamed on Anthony Sassano's Daily Gwei or maybe the eStakers. It'll just be a whole entire event. So that's on the horizon.
That's good. Another dress rehearsal down. David, speaking of down, though, NFTs have been down pretty bad. I don't know if you've looked at the price of your JPEGs lately, but it's not going to give you any comfort, okay?
I love all my JPEGs. I don't look at the price.
Yeah, okay. Yeah, it's just, David's just here for the images. Yeah. He's here for the art, okay? So NFTs, USD volume, it's back to like 2021 levels, like early 2021 levels.
Right.
Down pretty bad. But there is one bright spot in the NFT economy, and that is
ENS names. ENS names outperformers right now, especially the 3-digit numbers. Some crazy sales have happened in the last 3 days. 003.ETH got sold for 83.5 ETH. 8888 got sold for 38 ETH. 037 got sold for 30 ETH. 383 got sold for 27 ETH. Ryan, porno.eth got sold for 184 ETH. So ENS names are hot right now.
Yeah. Hotter than Sam.eth, which only came in at 100 ETH. So
poor Sam.
Porno's got you beat, Sam. Sorry. But yeah, look at these numbers, man. May was like the biggest month ever for
ENS
for
names.
ENS. And June looks like it's going to be strong too. So pretty impressive. All the while, Michael Saylor continues to dollar cost average into Bitcoin.
Right.
In the bear market, he hasn't stopped. It's probably a better time to actually buy the Bitcoin at this point in time. But he just purchased another $10 million of Bitcoin. David, are you getting concerned that like Saylor owns too much Bitcoin at this point? Like he's got to be close to 1% of the entire Bitcoin supply.
1% is 210,000, and he's got 130,000. He's still got a ways to go for 1%. The only thing I see when I see Michael Saylor buying more Bitcoin is like, dude, you spent all of your ammo at the top. Like that's not dollar cost averaging. He's just like putting in his fumes at this
expand your
point.
time horizon. The top of what? Not the top of the decade, okay? Just a local top. It's just a local top, my friend.
Oh, God.
You can't time these things. You got a dollar cost average.
A kind of a useful website, Ryan, you might want to pull this up while I talk about that, is bitcointreasuries.net. And so this can just show you people and the treasuries of people around the world and how much Bitcoin they have and what they bought it out. The cost basis for MicroStrategy is basically $4 billion. They've taken $4 billion USD and bought Bitcoin with that, which is currently valued in today's dollars at $2.4 billion. So they have lost $1.5 billion on their Bitcoin trade. They have down 40%. And then you can see how much of the 21 million they have. They have
Dude, that's not
0.6.
bad. I've been down worse than this. Good job,
40% or $1.5 billion?
Definitely the former. All right. I've been down worse than 40%. I do think that, like, I mean, I know people are making fun of him now. I do think this trade is ultimately going to pay off, like, really well. Like, when you zoom out, and, you know, the capital he's getting is kind of basically free. It's a publicly traded company. He's taking these, like, loans at very low Fed interest rates. I know that's not what MicroStrategy should probably be doing directionally, right? They're a business analytics firm, but it's probably going to pay off for them. I still think this.
I just see the $10 million is a drop in the bucket on their $2.5 billion position, which started at $4 billion. Like, you should have saved your ammo, dude.
Oh, yeah, but that's what everyone says, right? You can't time these things, in my opinion.
I'm also...
Sailor, I still support you buying,
I'm telling
man.
this to myself, too. Don't get me wrong.
Yeah. Keep buying the dip, Sailor.
Yeah.
It's, you know, maybe you could reverse things for us. David, this is a tweet from Niraj from Coin Center. And just to the crypto industry's attention to this, I thought this was an interesting story. Chinese officials are using the COVID health code system to stop a bank run. Oof. They turned all would-be withdrawals codes red before they could get to the bank, effectively unpersoning them. So what was happening in the banking system in China, what's been happening, is rather than suffer a bank run where individual citizens were going to the bank to try to withdraw funds, the banking system would just give them a COVID code, a COVID red code.
You are COVID positive. You cannot leave your house.
Exactly. Cannot leave the house, and effectively excommunicates you from the social system, but also the financial system. Right. So cutting off your bank access that way in order to prevent a bank run. This, my friends, is very terrifying. This is scary. This is the reason we can't have the nation states in control of the banking system and in control of the money supply. And with a bureaucrat's ability to just press a button and eliminate you from the economy. Why? To stop a bank run? Who knows? Who knows the why? What the why will be in the future? Maybe because you have different political persuasions. Maybe you voted a different way. Maybe you've said something publicly on TV. This is very terrifying to me. And I think I am most alarmed that countries in the West are actually embracing similar capabilities. Right. This is what a centrally administered central bank digital currency. Right. This is actually the power that gives.
They wouldn't even need to deem people as COVID positive. They would just skip that step and just go straight to like, no, you can't have your money. There's a quote from this article says, the news about the health codes has gone viral on China's social media platforms. Sooner or later, this sort of thing is going to happen to all of us. Wake up, people, one user wrote. National pandemic prevention policy has been reduced to a private weapon, said another. This is the height of expansion of power, ideological decay, and evil influence. Oof.
Guys,
coming to a CBDC near you.
The end of the decade, we're only going to have two types of money. There's going to be state surveillance controlled money, and there's going to be free money. It's all going to be digital. And the free money, the only free money available will not be cash anymore. It will just be crypto. So you got crypto and centrally controlled money, and those are the two options. And this is why we need to preserve crypto as an option. You hear that from us every time on Bankless. David, there was a bridge hack this week too. We got to cover that real quick. What happened?
Yeah, Harmony to Ethereum bridge, $100 million was stolen in another bridge hack. I mean, we've been here before. Ryan, you want to know who was behind it?
Who? Isn't it?
North Korea.
North Korea.
It was North Korea. Yeah.
My God.
So once again, North Korea hacked a bridge and now has all the money. Does not look good when half of this industry's hacks end up in North Korea's pockets. Oof. Bad.
You know, it was interesting in our conversation earlier this week with Matthew Green how he said he was having conversations with the U.S. National Defense, and they were like, "Hey, how can we come help the crypto industry to prevent hacks from these like happening? Right. Because every time North Korea goes and hacks something, right, they get more funding for their government to go, I don't know what, build
do whatever they do,
nuclear weapons or something like this. So it actually becomes these hacks actually become a national security risk.
Right.
Interestingly enough.
Right.
Crazy angle on that.
Use a layer 2, prevent nuclear war. Is that a fair take?
Yeah, it might be a stretch, David.
Is that a stretch?
There's something there. Maybe there's a future article, a David Hoffman article about this. Digital wallet maker Dynamic raises $7.5 million. Good to see a raise still coming through in the bear market. Anything special about this one?
Yeah, this is something that, for those that pay attention to crypto Twitter, Nick Carter and Castle Island Ventures put money into this round. An Ethereum wallet that has like digital identity features baked into it, and he got absolutely hounded by the Bitcoin community, like the Cyber Hornets, just because like from their culture, you don't touch anything that's not Bitcoin. And so Nick Carter, the blasphemous, sinning Nick Carter, touched something Ethereum. And now he's being like excommunicated from the Cyber Hornet culture. Just, a small peek into the window of Bitcoin maximalism.
Did you read his post? Bitcoin maximalism is dead, is bankrupt.
No, I haven't, but like I feel like I could already know it.
Yeah, I think he's over it, man. He's over Bitcoin maximalism for sure. As am I, as are you.
Always
Guys,
have been.
Still, even in a bear market, all right, this is an incredible time to get a job in crypto because crypto is still hiring. There was a lot of money created and raised during the bull market, and good firms are still hiring. Here are a few firms. I will read them out and their job openings. Number 1, AllianceDAO, CTO. AllianceDAO software engineer. AllianceDAO is also looking for an executive assistant. Go check that out. OtterSpace is looking for a Solidity engineer. Abstract Ventures, a front-end engineer. Boolean Labs looking for a founder, and Web3 for their Web3 community analytics platform, and a CEO. That's a big one. Bankless was still looking at Twitter specialist resumes. Blockchain Capital wants a research engineer. Swell Network, a tech lead. Go check out all of those roles
There's
on
so
the
many
Bankless
more.
jobs board.
There's so many more.
That's the place, bankless.pallet.com/jobs. Guys, we'll be right back. Come back with hot questions from the Bankless Nation, as well as some hot takes from Twitter. We'll get right back to that. But before we do, we want to thank the sponsors that made this episode possible.
Arbitrum is an Ethereum Layer 2 scaling solution that is going to completely change how we use DeFi and NFTs. Some of the coolest new NFT collections have chosen Arbitrum as their home, while DeFi protocols continue to see increased liquidity and usage. You can now bridge straight into Arbitrum from more than 10 different exchanges, including Binance, FTX, Huobi, and Crypto.com. Once on Arbitrum, you'll enjoy fast transactions with cheap fees, allowing you to explore new frontiers of the crypto universe. New to Arbitrum, for a limited time, you can get Arbitrum NFTs designed by the famous artists Ratwell and Sugoi for joining the Arbitrum Odyssey. The Odyssey is an 8-week-long event where you complete on-chain activities and receive a free NFT as a reward. Find out more by visiting the Discord at discord.gg/Arbitrum. You can also bridge your assets to Arbitrum at bridge.arbitrum.io and access all of Arbitrum's apps at portal.arbitrum.one in order to experience DeFi and NFTs the way it was always meant to be: fast, cheap, secure, and friction-free. The Brave browser is the user-first browser for the Web3 internet, with over 60 million monthly active users. And inside the Brave browser, you'll find the Brave Wallet, the secure multi-chain crypto wallet built right into the browser. Web3 is freedom from big tech and Wall Street, more control and better privacy, but there's a weak point in Web3, your crypto wallet. And most crypto wallets are browser extensions, which can easily be spoofed. But the Brave Wallet is different. No extensions are required, which gives Brave browser an extra level of security versus other wallets. Brave Wallet is your secure passport for the possibilities of Web3, and supports multiple chains, including Ethereum and Solana. You can even buy crypto directly inside the wallet with Ramp. And of course, you can store, send, and swap your crypto assets, manage your NFTs, and connect to other wallets and DeFi apps. So whether you're new to crypto or you're a seasoned pro, it's time to ditch those risky extensions, and it's time to switch to the Brave wallet. Download Brave at brave.com/bankless and click the wallet icon to get started.
Question time. Questions from the nation. A tweet goes out of the Bankless Twitter account every single Wednesday, and it says, "What question do you have for Ryan and David? Let us know." We'll talk about it every time I put this agenda together in the mornings. I go and check out all the hot questions, and I grab some of the hottest ones that everyone seems to want asked. So we got 2 of them this week. Dan Scott says, "Does bridging Ether to a layer 2 have similar risks as bridging Ether to an alternative layer 1 like Solana or Avalanche?" Ryan, you want to take this one?
Sure. I would say it depends. It depends on the bridge that you're using. But one benefit, if you're kind of like into visuals, one benefit that a rollup has versus an alternative layer 1 is it has a trustless, immutable bridge that cannot be destroyed. Okay. So it's a bridge that works regardless of any security dependencies on the chain itself, on the layer 2 itself, right? So if you're picturing kind of bridges in your mind, the other bridges routes around to layer 2s and to alternative layer 1s, these bridges can be destroyed. These could be like, these can crumble, these can fall if some of the security assumptions on the other chain go by the wayside. But a rollup always preserves a bridge where you can always withdraw your funds back to Ethereum. And that is why a rollup is a rollup. It's because it doesn't have dependencies that are external to Ethereum for your security. So there's always that bridge, but there are some bridges you can take to these chains that are also like multi-sig and don't have those same security assurances. So you have to be sort of careful and cautious as far as which bridge you're using to transmit your funds onto the layer 2.
I think there's a decent amount of like semantics confusion that goes around here when we bridge from like one layer 1 like Ethereum to another layer 1 like Solana or Avalanche. There's no actual like bridge being built. Like it's not like it's something you go across and you transport your ether from one side to the other. You put your ether into one contract on Ethereum, and then somebody else on the Solana or Avalanche or other layer 1 application is looking and observing that contract and say, oh, they submitted some ether here. I will mint them an IOU on the other side. So it's a little bit more like a teleporter. And like you have a central operator teleporting you with an IOU. And if the teleporter breaks, your IOU on the other side is worthless. With a layer 2 on Ethereum, there is something like a canonical bridge, a cryptographic bridge that has much stronger assurances that doesn't actually have to operate on like what is usually a multi-sig. And so you have just an extra layer of risk removed because the layer 2 bridges, they don't have to make their own independent blockchain. They are giving up their independence in the name of security and having an actual, it's still not an actual bridge because like, at the end of the day, the metaphor breaks down. But you have like strong cryptographic assurances that the bridge will always be there. And if the bridge isn't there, then the whole network's not there. So like Solana can go up and stay up. Ethereum can go up and stay up, and that bridge can go down. But on a layer 2, if the bridge goes down, the whole network is going down, right? And so the layer 2 network on Ethereum cannot stay up while the bridge is down. That doesn't work. And so
there's always a bridge of last resort
right.
on the L2s. And so it's less risky,
right.
is I guess the short answer,
right.
Bridging to a layer 2. And that is essentially the point. Okay, so here's another question for us, David. What are some of the best dApps that you can recommend to help beginners start living a crypto native life? A bankless life. David, what do you recommend?
Yeah, I put some of my favorites down. First, if you're going to go into the world of the bankless nation, if you're going to go into the metaverse, you need a name. You need your new metaverse name. And so you got to go get an ENS name. So go just like how when you sign into Instagram, sign into Twitter, whatever, and you make a new handle, when you're going into the metaverse, you need an ENS name. So go get an ENS name. Somebody got porno.eth. Maybe not that one. So once you get your metaverse name, I think the next coolest thing you can do is you can take some of your ether, you can put it into MakerDAO, and you can literally mint money. That is the cool thing about crypto. You can mint money. And then you can take that money, like put one ether into MakerDAO, like make sure you're measuring the gas fees, put one ether into MakerDAO, mint some DAI, put that DAI on a layer 2, and then you've done like some really cool stuff. And that's what I would say where I would start with.
I think that's great. And I think that like the path to going bankless is like, number one, you have to start taking custody of your own keys, right? So it's the move from an exchange to actually taking custody of your keys. Whether you're doing that in a smart contract wallet, like an Argent or something, a hardware device like Ledger, or for small bits of money, maybe MetaMask, something like that. You have to go through that step. But once you're on the other side of that, I think about still like the money verbs that we've talked about, so often. Like, what are the things you want to do with your financial life in a typical banking system? Well, one thing you want to do is like save your money and invest. And I can think of no better investment, my friend, and saving mechanism for the long run. It's going to be volatile in USD and ups and downs than something like ETH, okay? And maybe after that, a basket of some other tokens. But you definitely want to have ETH that you don't spend, all right? You also need some ETH for gas, but ETH that you don't spend. So that's like a store of value type use case. Mm-hmm. And then once you have that payment use case, stablecoins are amazing. Dude, I could send money to anyone in the world. Right. For like fractions of a penny, okay? And like it can be any amount of money. This is so freeing and so cool, and it's something that you should learn how to do. Whether you're using USDC or DAI, having some stable coins in your crypto reserves is kind of cool. Then you can use something like Pool Together, which is like a fun DeFi savings type tool. It's a really interesting starter application in DeFi. Go check that out, Pool Together, and you can deposit your funds, actually save your money. They have a lottery. It's called the No Loss Lottery. They have a system that, rewards various people based on the pool size. It's really cool. Just check it out. It's a good first app. If you're lending and borrowing, Aave is fantastic. And then trading, of course, like go check out Uniswap. So we got storing value, basic payments, savings, lending, and trading. And that's a good place to start because you just knocked off 5 of the different money verbs that you're going to need for a crypto native bankless life. From there, you can do all sorts of other things, but that's where I would start. David, let's get to some takes of the week, man.
Takes of the week.
So here's a take from you, my friend. This is all about CeFi versus DeFi.
I say CeFi lenders are blowing up specifically due to the properties of centralization. They're black boxes. You got to trust them to withdraw your assets, and they're subject to human folly, human decision making. Not only now do DeFi lenders have fewer competitors because a few of them have blown up, but their competitive edge is now proven and legitimized. CeFi is fragile and unstable. DeFi is robust and stable. And so I think it's that last line. DeFi has fewer competitors because all the CeFi things blew up. They blew up because of the properties of centralization in the first place. So now, not only do they have less competition, but their differentiation is justified and proven out in the market. And I think that's awesome.
I totally agree with you. And, I think another lens on this is something I tweeted out, is for regulators. And I said this: regulators around the world should be watching DeFi protocols closely to congratulate them. All right? Because DeFi provided a fair, orderly, and transparent drawdown during the 70 to 90% downturn we've just seen. Well, its CeFi peers went bust. You want to regulate crypto? DeFi is crypto regulation.
Self-regulation.
A commenter on this tweet said, yeah, that's effectively what a smart contract is. It's regulations written into code.
Yes,
that's what we're doing.
That's the whole point. The EVM is the regulator for DeFi. We are that. That's the whole thing that makes it what it is.
Exactly. Smart contracts are simply self-regulating and self-enforcing themselves. And this is where regulators can lend a hand, is maybe they need some smart contract auditors on their team. Maybe they want to spin up some transparency dashboards.
Right.
This is where DeFi can use your help, not to say that, we're getting rid of all DeFi. Anyway, don't know how many regulators listen to Bankless, but that's our message to them. Here's another take, David, from Aubrey. What's she saying?
Yeah, Aubrey, the first time we got an Aubrey take in here, she goes, SBF will own everything and you'll be happy.
Why is she saying this?
Because SBF is buying up everything. He's the lender of last resort. He's trying to buy FTX. They provide a credit window for a bunch of other things. SBF and Alameda and all these people that were capitalized during the bull market and had a lot of stables are now looking at some pretty sweet deals right now. So
I don't think this is a fair tweet, David, because CZ is going to own at least some of this too.
Yeah, CZ.
Not
CZ
just
too.
SBF.
CZ too.
We're having CZ on the podcast tomorrow, so we're going to ask him about this. CZ of Binance, of course, is also...
Today, for the listeners, actually is probably going on right now as you listen to it.
Oh, true. Wow.
Okay.
Stop listening to the Rollup.
I really liked this take. This is a kind of a snarky way that also is really educational as to how optimistic rollups work. Kobe Gurkam says, the security of optimistic rollups is based on the fact that people will, with great zeal, strive to prove that somebody is wrong on the internet. This is how a fraud proof works. If you do something fraudulent in an optimistic rollup, you can get away with it. But the way that security of these optimistic rollups work is as soon as somebody's doing something fraudulent, somebody's out there going to prove that. And so security of optimistic rollups based on the fact that the internet people like to prove that other people are wrong. And if they do, they get rewarded. So that is a little quick lesson in how optimistic rollups are secured.
Everyone becomes an auditor.
Right.
That's the model we're moving towards. This is a take from Bartek.eth. Being an Ethereum rollup is like having the strongest army in the world securing your estate. Becoming Cosmos Chain, you are now protected by your token holders, unless you use interchain security, an upcoming feature, in which case you pay Atom holders for protection. I think this is probably background commentary on DYDX's move
Certainly.
from a Starkware rollup to its own app chain. And I know you and I commented on this after the show. We have a ton of respect for Antonio as a builder. He's built something phenomenal with DYDX. But it also seems like it's going to be a lot of work for them to spin up everything necessary for a layer 1 chain. And kind of the analogy to me is like, you want to start a butcher shop, and so you're founding a country in order to do that. I was like, well, why not just park your butcher shop in a country that already exists? Because then you don't need to spin up your own military and tax code system and money system and monetary policy and like defense network and legal. Like, it seems like a lot less work, and I think it is. And so this is a comment on that. I do think that there's obviously room for all sorts of chains to spin up, but what they are spinning up is sophisticated nation-state type of economies. And I think that's more difficult to do than some people assume.
I think that's exactly right. And I think that is the last of the takes. Ryan, should we get into what we're excited about?
Yeah, what are you excited about? What are you bullish on?
Do you see this like awesome brick background behind me, Ryan?
I do. It's amazing. It looks like you got a ton of room there.
Right. Yeah. So like, look at all this space, and like my desk is in the middle of this space. Let's see if I can zoom out. It starts off as a blank brick background, but it's gonna change in the future, Ryan. And I'm not just talking about me putting up my NFTs on the wall. That's
what people are envisioning. How's it going to change?
I'm sure that's what they're envisioning. It's going to change. Bankless Studio is going to become a thing. I got some plans. Live
studio for live podcasts. That's what you're talking about, right?
Yes.
This is what this means.
Yes. Yeah. I did a show with Julia from Orca not too long ago, and like we were very awkwardly like on the same couch as I interviewed her. And then I looked at the YouTube comments. I was like, well, that needs to change.
So this is the change. Bankless Studio. It's going to be awesome, man. Yeah. I'm excited to come up there one time with you.
Yeah, we'll do your layer 0
I'll get you on a... No, I was going to say I want to get you on a layer 0.
That's my podcast, bro.
I know, but I got to interview... Who's going to interview you? You know,
That's a good question.
Anthony Sassano interview you for layer 0? It's got to be me. Come on.
Yeah, that's right. Ryan, what are you excited about?
I'm excited, I guess, about the overconfidence of bears right now. Here's something I tweeted out. When prices go up too fast, people get dumb. Of course, that's true. But when prices go down too fast, people also get dumb. And I'm seeing a lot of the dumb sentiment now, David. Mm-hmm. Like, just this morning, I was like cruising around Reddit. The amount of threads, this was like on r/gaming of like, NFTs were the dumbest idea ever. Ha, crypto bros, get wrecked. You guys suck. Crypto's so useless. It's a scam. All of this noise is going on. And like detractors and critics are absolutely gleeful, right? And what they don't know is like, we've already been through this like 3 or 4 times. Exact same people, not the same people necessarily, exact same sentiment, maybe different set of actors. Crypto is dead. And I think the overconfidence of the bears actually makes me optimistic that we are closing in on a potential bottom. Mm-hmm. All right. Now, this could still last a very long time. We're still talking months, potentially years. I don't know how long it's going to last, but I'm starting to hear that like overconfidence that feels very much and sounds very much like bottom type of talk. And I think it'll persist for a while, but it's actually making me bullish to hear the same patterns that we've seen so many times in crypto start to play out in the sentiment right now.
So just curious, when prices go up too fast, people get dumb. When prices go down too fast, people also get dumb. In what scenario do people not get dumb?
I think when like there is a sweet spot of sober time. Do you know, like, don't you feel like this in every market? Like the sweet spot was probably for me for this cycle around was probably like sometime 2020, early 2020, especially.
DeFi summer.
Yep, and I think in late 2019 into 2020, I feel like we had 6 months or so, maybe 9 months of just the sweet spot, where things were happening, the builders were building, the market sentiment was like rational.
So the end of the bear market.
Mm-hmm.
Right.
Basically. And that's the sweet spot. And then I start to hate my life again. Like I hate my life. I hate my life now when things are like irrationally bearish and everyone's like, you're such an idiot. You're such you have a crypto podcast. But then I also hate like the market, I don't know, 3 months ago, 6 months ago, when you're like, this Terra thing might not be sustainable. And everyone's like, you loser, you're so dumb, you ETH maxi. Like, I hate that side of it too. So we only get rest during like this 8-month period, I don't know, 6 to 9 month period, maybe in between these two cycles, and that's when the market is less dumb. That's how I experience it.
I think I talked about this last week with Anthony when you were on your little AI vacation. But like my mom would text me every now and then saying, "Hey, I met up with like Linda. She said like, hey, how's Dave doing? Is Dave doing all right during the crypto crash?" And like I've gotten these texts like 3 times.
Oh,
like,
no.
is David
Really?
is David okay? Like, and they know I've been in crypto since 2017. I'm like, can you guys please go look at the chart, please? I tell my mom like, hey, I'm hiring a Bankless if they're looking
at a chart.
Well, no, tell those people to go look at the chart, like Ether at $1,000. Anyways, but just like, yeah, it's just like so frustrating. It's like they don't really ask if I'm doing okay when Ether is at $4,000.
Right.
I didn't hear anything then.
David's mom, don't be concerned about David until ETH is like double digit, okay? Then you can start sending phone calls and getting
Then I
concerned.
might not be okay at that point.
You might not be okay. But Bankless listener, we think you're going to be okay. This is all going to be okay.
Ryan, you said at the end of 2019, start of 2020 was when you felt like most rational and like just the best in the crypto market.
Yeah.
Like that was the era in crypto, and I was thinking about this earlier. That was the era in crypto where all the people that stuck around during the bear market, that's when all the people were like, yo, wait, the bull market, it's on. That's what happens next. Like people that stuck around during the bear market, they identified that the bull market was started in April of 2020. Like we knew this. Everyone had the conviction, like, yes, the bull market's back on. Like it's on, baby. And the only way that you were able to know that was if you rode through the bear market. And so the people that rode through the bear market were able to ride the bull market from Genesis in like April of 2020 when Ether was $200 to $300, Bitcoin was like $6,000, $7,000, and then they rode those things like before, and then retail figured out that the bull market was on sometime in like middle of 2021. So if you ride through the bear market, you have a 1-year head start in a bull market that generally only lasts about 2 years. So like that's your alpha. That's your advantage.
It's exactly where you want to be. And that is the reason you don't leave during times like this when prices are down. The reason you stay is exactly for that reason.
Totally.
All right, David, let's get to the meme of the week. What are we looking at on the screen? I'm seeing a whole bunch of bulls here. These look like sad bulls, though.
This is what are these called? The Dungeons and Dragons like disposition charts or whatever. So you got like lawful good, neutral good, chaotic good, lawful evil, neutral evil, chaotic evil. So for the listeners, podcast listeners, sorry, this is gonna be kind of hard to explain. In the lawful good corner, we got good old USDC. Being the lawful good. Like everyone likes
These
USDC.
Are all stable coins,
These are all stable
right?
coins. Every single stable coin, yeah. In the neutral good, top center, we got DAI. It's neutral. It's $1. It's good. And we also have chaotic good for Frax, the algorithmic 85% backed algorithmic stablecoin that has admirably held its peg. Nothing wrong there. Coming up in the neutral camp, we got the lawful neutral of the actual US dollar, the fiat in your bank account, the cash in your wallet. In the true neutral corner, we have the Curve 3 pool, the Tether, DAI, USEC Curve 3 pool, and the bull. Every single one of these has a bull that's colored the color of the stablecoin, and this bull happens to be both green for USEC, blue for USEC, green for Tether, and yellow for DAI. So true neutral is the Curve 3 pool. Chaotic neutral, we got MIM. Didn't that one go to 0? I don't know.
Not yet. I don't.
Yeah,
did it?
I don't know. And then in the evil row, we got the lawful Ether, which is evil, which is Tether. It's lawful because it's actually $1, redeemable for $1, but it's evil because it's a black box. We got the neutral evil, which is USDD, the Terra fork on Tron that somehow is maintaining its peg. And then we also have chaotic evil in the bottom right corner, which is UST, Terra USD, with also, if you notice, Ryan, Mike Novogratz wolf tattoo on the arm.
It's crazy, man. I definitely agree with the bottom row, I think. And particularly the chaotic evil being UST, but also this Tron stablecoin, man. Like, that's got to be next to go.
Yeah.
Right? Like Justin Sun, I can't believe the audacity of this. I'm going to spin up a stablecoin a month before UST goes, and it's going to be algo-backed same kind of mechanism as Luna UST. And like that is not okay. And if you're in that, like, be very, very careful.
Yeah, it's a game of chicken.
Probably not listening to Bankless, though.
Yeah, that's probably true. I saw a post that talks about how Justin Sun had plenty of capital to backstop the USDD depegging and depeg down to 94 cents, but he wanted it to depeg more so he could buy it at like a cheaper discount.
So dumb. This is terrible. Justin Sun as a central banker. No, thank you.
Right.
Give me ETH, give me Bitcoin.
Yeah.
Guys, of course, none of this has been financial advice. It never is. Crypto is risky, so is ETH, so is Bitcoin, so is all of it. You could lose what you put in, definitely, but we are headed west. This is the frontier. It's not for everyone, but we're glad you're with us on the Bankless journey. Thanks a lot.
BlockFi! Rocket ship, get on board!
So why is...
Hey, we hope you enjoyed the video. If you did, head over to Bankless HQ right now to develop your crypto investing skills and learn how to free yourself from banks and gain your financial independence. We recommend joining our daily newsletter, podcast, and community as a Bankless Premium subscriber to get the most out of your Bankless experience. You'll get access to our market analysis, our alpha leaks, and exclusive content, and even the Bankless token for airdrops, raffles, and unlocks. If you're interested in crypto, the Bankless community is where you want to be. Click the link in the description to become a Bankless Premium subscriber today. Also, don't forget to subscribe to the channel for in-depth interviews with industry leaders, Ask Me Anythings, and weekly roll-ups where we summarize the week in crypto and other fantastic content. Thanks everyone for watching and being on the journey as we build out the Bankless Nation.